December. But we also have Ashi Anand joining us on the show, founder and CEO at IME Capital. Ashi, hi, good afternoon, and thanks so much for joining us. Give us your sense of the limited set of earnings that we've seen so far from TCS, DMart. All eyes are on HCL today. But given the kind of updates we've seen across the board, do you believe that this quarter could be better than the one before it?
Hi, firstly, thanks for having me on the show. It's probably just too early to comment on that at this point in time because we just kind of 2 quarters, we really just 2 companies in. I think the one important thing with a TCS is people. So what are the things that people were looking through to read through into these sectors from these company results, right? So with TCS and IT, people were looking at some kind of an indication of a kind of growth recovery. If you look at TCS's guidance, I don't think you still have clarity on that yet. And for any longer term growth recovery in IT, you are going to need some clarity around what is happening with Trump and tariffs, the impact that is going to have on the US economy, as well as overall corporate demand and corporate demand specifically on IT spends. I think the other key element was actually DMart. We still, like I'd like to just mention, very, very early into the result season. But with DMart as well, you have kind of seen that growth, the whole consumer growth recovery, that is still not something which is evident. DMart is kind of still struggling in terms of trying to get its kind of merchandise mix back up to levels it was historically to be able to get back to the kind of margins that they were delivering earlier. And I think this whole new quick commerce competition, right, and the implications of that on a model like DMart, that is still something that you are sitting and trying to evaluate. The result season is going to be something which is extremely important. We are watching it very closely. We've had the two key results so far. Trends so far are not really suggestive of a big growth recovery as compared to what we saw in the previous quarter.
Or either on the other side, it's life insurance counters that have been doing well. Well, of course, all eyes will be on HDFC Life as well. But Ashi, just wanted to have your take on the whole insurance pack because from general insurance and even from the life insurance, the month-on-month growth data has been quite stable. What is your overall sense on the insurance space and any particular segment within that you're finding attractive at this point in time?
Yeah, sure. So insurance is a space that we do like. It is also there in currently in our portfolios. What we do particularly like about insurance is the fact that valuations have kind of come off quite significantly. And if you kind of try building out longer term growth models, you really aren't factoring in very robust growth in a sector which is still highly underpenetrated in the Indian economy. And just as financialization of savings continues, you are going to kind of continue to see decent growth and kind of penetration increase. So this is the space that we like. We see it as a very attractive longer term buy and hold kind of a play. What you are going to see, however, is kind of month on month and year on year volatility in kind of numbers. This actually happens for a couple of 2 or 3 key reasons, right? And this is what's been impacting performance for the sector over the last few years. I think the first element is around the state of the equity capital markets that does have an impact on kind of ULIP growth and the margins that these companies make on ULIPs versus other products. That is actually quite different. ULIP is a lower margin product. And because of that, whenever you do see a strong equity market environment, you see positive APE growth. But that is very often accompanied by a certain amount of margin pressure. And which is where I think the core number that we tend to focus on is the growth in absolute VNB. Now that is something which we believe over the next 5 to 10 years has the potential to continue to grow in kind of early teens, as is what you've been seeing over the past some amount of time. And that for when you can kind of buy companies at 2.5 times price to EV, that is not something which is very expensive, and which is why we do like the space. The space has not really performed as much over the last couple of years, and this has been because you have seen kind of changes in underlying regulations. Some of these regulations are actually helping make the sector stronger from a longer term perspective. So we actually kind of see it as a space which does have kind of room to kind of grow, room to outperform. As growth comes back, we actually expect the space to do quite well.
Okay, so that's the take on the entire insurance space.
Whole tire space is actually doing very well, and one of the factors is actually the upcoming earnings, because the management have already highlighted for majority of the companies that the lag impact of a softer RM basket cost can actually kick in terms of the margins, and they are expecting a recovery in the first half of this fiscal and beyond, depending the crude oil prices. But Ashi, just wanted to have your take though on the auto OEM side. Nothing much is happening there, but everybody just talks about to be with the auto ancillary space. So do you believe the tire is a good bet for that?
So rather than specifically tires versus not, right? As in, if I can just address the whole auto OEM and the auto anch debate and why kind of people are possibly at some level preferring auto anchs. What you are kind of seeing happening in auto OEMs is that competitive pressures have increased quite substantially. And this is especially true when you kind of take into account the impending shift towards EVs. If you're looking at kind of two-wheelers from a very cozy kind of three-player market between your four-player market, your Hero Honda, your Honda, Bajaj, and TVS, as compared to this, you now have new EV entrants coming in, and you really don't know how market shares under the new EV landscape would actually shape up. You are also seeing something similar happening in passenger vehicles. While the EV shift is a bit slower, what you are clearly having here is Mahindra and Tatas have clearly gotten their act together and been able to kind of gain significant market share away from the erstwhile Maruti, which is really dominant. You also have new players like Kia and an MG come in and take in certain levels of market share. Now, as the space also moves towards kind of an EV mode, you really don't, as of right now, have visibility on how market shares are going to play out and how longer term profitability is going to play out under the new EV mode. And this is what makes it quite difficult to really take a longer term structural call on auto OEMs. And this is where certain market participants are saying if you can identify auto anchors that are engine agnostic, so which are not dependent on is that particular ancillary part going into an ICE engine or an EV. The requirement is there across both vehicles. These become a much easier play to play this larger discretionary boost in consumption that you're likely to see in India. And I think that is really where auto anchs and say, and which is where kind of tires kind of do fit in, right? Tires aren't really dependent on the kind of vehicle that you're going into. In the current kind of quarter, you are, as you had mentioned, going to have a bit of a margin boost because of easing raw material prices. But that's more of a shorter term thing. I think the core call is auto anchs that are not engine dependent actually have greater growth visibility as of today, as compared to when you are kind of dealing with auto OEMs where market shares, EV transition, there are multiple kind of balls up in the air and you don't really know where they're going to land.
Okay, that's the take on the entire auto anch space and the OEM space. Let's shift focus from that and talk about Bitcoin, because Bitcoin has extended its rally to rise to a new record level above $120,000, driven by strong institutional inflow and optimism around crypto-friendly policies under the new Trump administration. The world's largest cryptocurrency has now gained more than 29% on a year-to-date basis and over 100% in the past 12 months itself.
But Ashi, any comment on what does it really tells about the investor sentiment and the risk appetite right now? Because on one hand, not just Indian markets, I believe globe across, the equity markets are waiting for more clarity. A bit of a sluggishness is what we are seeing. But on the other hand, it's Bitcoin at an all-time high levels. Any comments here?
So very difficult for me to comment about Bitcoin. Crypto is a space that we don't necessarily understand as well. But I think what you can clearly make out, right, is what this suggests of the underlying environment. I think risk-taking appetite still remains fairly strong. You're seeing this in kind of the kind of rallies you've seen in gold, silver, as well as in cryptocurrencies. The reason your kind of equity markets are not being able to participate is that you currently have a large amount of uncertainty around Trump, what he's going to do around tariffs, the impact this is going to have on global demand, on the US economy, and how the US Fed is really going to react in terms of interest rates. Until you don't have some clarity around here, it's a little bit difficult for kind of a larger bullish sentiment to actually build and sustain. And I think which is where you're really having some amount of monies move towards other asset classes like metals and cryptocurrencies. But as you kind of have some clarity around this overall direction of both growth, trade, and kind of interest rates, I think that is when you start seeing equity markets possibly participate and possibly a reversal of some of this kind of big up moves that you've seen in crypto and precious metals.
Okay, so that's the take on Bitcoin and alternative asset classes right now. But
Minutes left before we shut shop, and for today, a mild recovery that what we are seeing on the index front, because Nifty Bank is actually trying to make that close in the green. But on the flip side, it's Nifty 50 which has once again taken a support at that 25,000 odd mark and seen a mild recovery from the day's lowest point as well. Select counters within the pharma space did well, but on the flip side, it was Divi's Lab that was a bit reeling under pressure. But Ashi, any comment on the pharma space right now? Any particular pocket that you believe is looking interesting to you right now? Because of late, the excitement was really on with respect to the CDMO players. But do you believe maybe on the valuation front, now it's the time to nibble into some of these generic players as well?
So pharma is quite interestingly poised. I think there are two or three kind of a combination of two or three factors operating as kind of headwinds and potential tailwinds. I think the one big concern that we really have is around the Revlimid base. This was a very, very large opportunity that contributed a very large percentage of overall profits for a number of Indian pharma companies over the last 1 or 2 years. And as this kind of drug becomes more generic, you are going to see a base impact which becomes difficult to grow off. So while this is kind of the one key concern, and it is important to just kind of look at valuations adjusted for some of these one-off profits on a Revlimid. What is very attractive, at least to us, is this whole GLP-1 opportunity. As GLP-1 drugs start coming into emerging markets, you potentially have interesting opportunities both amongst the branded generic players who could be launching their own versions of GLP-1 drugs, but you also have a number of interesting CDMOs that with specific facilities that are targeted towards this particular opportunity. GLP-1 is something which could be something quite large and quite monetizable over the coming 3 to 5 years. And it'll be interesting to kind of understand which are the companies that become the winners in this particular place. The one other key element is that there's a bit of an uncertainty around does Trump look at kind of implementing tariffs on this particular place. It's something which is not expected, and you have heard kind of contrary news flow out here. We believe that drug prices in the US are already way too high. Increasing tariffs are not really going to solve for anything. But that is going to be a bit of an overhang on the sector until there's no clarity on what's happening with Trump and tariffs. So it is a space that we believe you do need to be a bit stock specific on, because there is a specific kind of Revlimid which is causing a bit of a base impact, and there are companies will kind of differ in terms of how well they actually monetize the GLP-1 opportunity. But if you do get the stock specific call right, I think this is a space which is definitely quite interesting.
Ashi, thanks so much for joining us. On that note, we'll let you go. Well, only a